More than half of Americans do not know how their own tax bracket works. Tax Foundation, 2024. That misunderstanding has a price. For a worker earning $75,000, the gap between the tax they fear and the tax they owe is dramatic. They believe they are taxed at 22%. They are not. The IRS has no legal obligation to correct them. The ledger does. Here is what the United States Tax Code actually says. Your income is not taxed at one rate. It is taxed in layers, 7 layers. Each layer has a ceiling. When your income exceeds that ceiling, only the excess moves to the next layer. The layer beneath it stays taxed at the lower rate. Every dollar. Always. That system has a name. It is called a progressive tax structure, and the majority of American workers have never understood it. Let us run the exact numbers for 2025. A single filer earning $75,000 in gross income. Most Americans in that position believe they are in the 22% tax bracket. They are correct about the bracket. They are wrong about what that means. Here is what actually happens. The first $15,750 of income is removed entirely from taxation. That is the 2025 standard deduction. Taxable income is now $59,250. Of that amount, the first $11,925 is taxed at 10%. The next $36,550 taxed at 12%. Only the remaining $10,775 taxed at 22%. Total federal tax owed $7,949. Effective rate 10.6%, not 22. 10.6. That gap is not an accident. It is a function of a system designed to collect maximum revenue from maximum misunderstanding. A third of American workers believe their highest bracket rate applies to their entire income. Tax Foundation, 2024. 1 in 3 workers is calculating their own tax liability incorrectly and making financial decisions from that miscalculation, turning down overtime, hesitating on a raise, structuring income to avoid a bracket they misunderstand. The fear of the bracket is costing more than the bracket itself. Here is the mechanism precisely. Think of 7 buckets arranged in sequence. Each bucket has a capacity. Income fills the first bucket at 10% until it is full. Then it fills the second at 12%. Then the third at 22%. Moving into the 22% bucket does not change what happened in the first 2 buckets. Those dollars are already taxed. At 10%, at 12%, they do not renegotiate. The concern that crossing a bracket costs more than it earns is mathematically impossible in the American federal tax system. A pay raise always increases take-home pay. Always. The same misunderstanding scales with income. For a worker earning $100,000, the effective rate is 13.5%, the gap between what they fear and what they owe. $8,551 every year. That is, money workers believe they owe, that they do not. The standard deduction is the first number that should change how you think about your taxes. For 2025, it is $15,750 for a single filer, $31,500 for a married couple filing jointly. This amount is removed from your taxable income before the bracket calculation begins. A worker earning $60,000 does not pay taxes on $60,000. They pay taxes on $44,250. Most workers do not know their own taxable income. They know their salary. Those are not the same number. Above the standard deduction, there are additional reductions available to most workers that do not require itemizing. They apply regardless of whether you take the standard deduction. They reduce your taxable income before the standard deduction calculation begins. They are called above-the-line deductions. Here are the ones most workers are not claiming. A health savings account contribution. For 2025, the contribution limit is $4,300 for individuals, $8,550 for families. Every dollar contributed is deductible. Growth inside the account is tax-free. Withdrawals for qualified medical expenses are tax-free. No other account in the American tax code offers all three of those protections simultaneously. Most workers with qualifying high-deductible health plans have never opened one. A traditional IRA contribution, up to $7,000 for filers under 50, up to $8,000 for filers 50 and over, fully deductible for workers without an employer retirement plan. This deduction does not require itemizing. It comes directly off your adjusted gross income. A worker in the 22% bracket who contributes the maximum saves $1,540 in federal taxes before they invest a single year of returns. Student loan interest, up to $2,500 deductible per year. No itemizing required. The deduction begins to phase out above income thresholds, but for the majority of Americans carrying student debt, it applies in full. Most never claim it. Now, to the deductions introduced by the One Big Beautiful Bill Act, signed into law on the 4th of July, 2025. These are new. They apply to 2025 through 2028. They are above the line. They apply whether you itemize or take the standard deduction. If you receive tip income in a qualifying occupation, up to $25,000 of that income is now deductible. Internal Revenue Service, 2025. This deduction phases out for those earning above $150,000. Below that threshold, it applies in full. By March of the 2026 filing season, more than 4.6 million Americans had claimed this deduction. Treasury, March 2026. Millions more qualified and did not claim it. If you receive overtime pay, governed by the Fair Labor Standards Act, the portion above your regular rate is now deductible. Up to $12,500 for single filers, up to $25,000 for joint filers, for 2025 through 2028. By the 20th of March in the 2026 filing season, nearly 20 million Americans had claimed this deduction. Treasury, March 2026. The workers who did not claim it did not lose that money to higher rates. They lost it to not knowing the deduction existed. There is a distinction here that the Tax Foundation's National Literacy Survey found most Americans cannot answer correctly. A $1,000 tax credit and a $1,000 tax deduction are not the same thing. A credit reduces your tax bill by $1,000. A deduction reduces your taxable income by $1,000. At a 22% marginal rate, a $1,000 deduction saves $220. The credit saves 5 times more. Most workers do not know this. They are claiming deductions when credits are available and leaving hundreds of dollars in the system annually. The average tax refund in 2025 filing season was $3,167, the IRS filing season statistics. Most Americans receive this figure as welcome news. It is not welcome news. It is $3,167 that belong to the worker for the previous 12 months. Held by the federal government, interest-free, returned without apology. A tax refund is not a gift. It is a structured overpayment caused by the same bracket misunderstanding this video began with. The mechanism is this. When a worker believes their 22% bracket applies to all their income, they tolerate higher withholding throughout the year. They accept it as correct. The W-4 form is the instrument that controls withholding. Most workers have never adjusted it after their first day of employment, adjusting the W-4 to reflect the actual effective rate returns that money to the worker monthly. $264 per month in the case of the average refund, not in April, every month. Here is what the ledger shows on the American tax system in 2025. More than half of American workers misunderstand the mechanism that determines their tax bill. Tax Foundation. 2024. That misunderstanding causes workers to turn down raises that would increase their take-home pay. It generates an average annual overpayment of $3,167 held by the government interest-free, and it leaves billions in above-the-line deductions unclaimed by workers who qualified and never knew. The tax code is a public document, published in full, available to anyone. The deductions inside it are not secrets. They are published by the same agency that collects the revenue. The agency has no interest in reminding you they exist. The ledger does. The United States tax system is designed to collect the maximum it can from the minimum number of questions. The workers who ask no questions pay the most. The workers who understand the mechanism pay what they actually owe, and not $1 more. That is not tax avoidance. That is arithmetic. The Wealth Ledger publishes verified financial data every week. No predictions, no opinions. Subscribe at newsletter.wealthledger.co. The data is free. The refund is yours. The IRS does not send instructions. It relies on most people never calculating the difference between their marginal rate and their effective rate. The system hoped you would never check. The ledger never lies.